Good morning and happy Monday, everybody. Your man Omid here with you to make sense of the market once again. What a crazy couple of weeks it's been. I hope that you did not lose any money on the Tyson fight, and I hope that you came away unscathed. I think there was a little bit of switching and baiting going on there. Speaking of switch and bait, what's going on with this market? It is definitely switching and baiting us. We went from a place where we saw lower rates and a promise of things that are going to be okay in September to the opposite of it in October. And now here we are in November, kind of trailing the same. Let's talk technicals real quick. Mortgage bonds are trading between the support of this Fibonacci level of 100.43 and this ceiling of resistance, if you will. It matches exactly to what's going on with the 10-year Treasury. That is, as of last time I checked, was at 443. So it's pretty healthy, and that is happening because of one thing and one thing only, and it's inflation. You see, treasury bonds in general are a fixed point of return. And so if inflation continues to be on the rise, it erodes their value. And therefore, the traders want more for their money and they jack those rates up, which in turn jacks up the rates to mortgage markets. And so we can see that we are still very much so kind of oversold here as far as the trends goes, the statistics. We've been oversold for a very long time with not a whole lot of buyers coming into the market. So this is all interesting to watch. What does that mean for rates? 705 last week, 708 this week. Again, not a tremendous amount of movement. However, clearly above 7 and kind of staying there from the looks of it all. And again, I'll explain here in a second why that's important, and I'll explain in a second how we can combat this internally by using home ownership as a hedge. So I thought this was interesting. This is annual inflation versus cumulative information. So cumulative line is the blue line. As you can see, annual inflation is the red line, and you can see that it jumps up and down and kind of moves and spikes and peaks and falls. But the one thing that I want you to notice here is that cumulative line, the blue line, is just kind of up there, and it's continuing to stay up there. And part of what's also happening is, as you can see, that inflation is being reported down here as an example on this graph, and what we're seeing way up here as far as the cumulative. This, in my humble opinion, it has a lot to do with what it is that we're paying for corporate greed, what it is that we're paying for, all these higher stock prices, etc. That money is coming from somewhere, and it is from the bottom line of the companies that sell us goods and services. And so as long as we keep doing what we're doing, and this country is in credit card debt up to $1.2 trillion as of now, we got to slow down spending, and we got to do that in order to be able to control this inflationary issue. I've got this out of stack order here, so I'm going to come back to it. But so Secretary Powell met last week, and his words were very important, and we all got to pay attention to him. But really, at the end of the day, I'm not going to read all this to you. You can pause it and read it yourself. However, the takeaway here is this, is that the PCE, the personal consumption expenditure, which is their favorite measure, is sitting at 2.8%, and unemployment is holding steady at 4.1. So what he said is that the economy is not sending any signals for me to be in a hurry to lower the Fed funds rate. And that's what everybody's kind of waiting on and hoping for. So the shift in rate cut expectations, this is an important piece right here. December rate cuts went from 72% down to 58, and expectation of a stable rate increased to 41. Stable rate means we're going to not touch it. We're going to leave it alone. That's the camp that I'm in. I think in December, when they go to announce, they're going to leave it alone. And so what we're seeing now as a result of that is a mortgage market which is trying to find some direction, and where there is none, it will always go a little higher. So how do we hedge against this? Well, we first turn off our phones, but how do we hedge against this? We hedge against this by, you guessed it, home ownership. I want you to see something here. There's a lot of information out there, a lot of Instagram kind of know-it-alls that talk about, hey, we shouldn't be buying. This is the time to rent. Rent is cheaper than purchasing. And you know what? They're right. Rent is cheaper than purchasing. But you know what's also cheaper than? Not putting money in your 401k is cheaper than putting money in your 401k. But you still do that. And this is the thing that I want to show you. Look at in 2019, the average net worth, meaning that from all their debts and all their credits for a home renter, was $7,300. That was 40 times less than what the homeowner saw. In 2022, it was $10,400 as compared to $396,000. In 2024, not done yet, but that's the estimate. $10,000 versus 415,000. So I would really challenge the thinking that buying a home is not the right idea because the monthly payments are higher than the rent payments. Yes, of course they are. But look what happens when you rent and look what happens when you own. And this has been the case for the last 78 years that we've tracked this data. So I think the takeaway here is this: inflation, the market, the presidency, the Mike Tyson fight. It's out there, and it's anybody's guess as what it's going to do next. But we can take advantage of this current market where there are higher rates and less competition. We can take note of all this information and go out there and execute what is in our power, which is to go buy a house, which is to invest in ourselves and be able to start accumulating wealth and creating wealth for not only ourselves, for the next generation. Nothing on the books really majorly market moving for this week. So that's why I left this at the end. Really, the biggest thing that I'm going to be watching for this week is Thursday's initial jobless claims to see if that employment number moves in any way or not. But other than that, that's about it for this week. Okay. As always, I appreciate your attention. Subscribe, like, and comment to this. And please do share this with folks that are either in the market or thinking about getting in the market. Let's educate those around us because an educated buyer is a happier buyer. Okay. Have a fantastic week. Chat with you soon.